Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to give an update to the economic situation that we're facing and go over the recent statements by the Fed that Jerome Powell made at the last IMF meeting this past week. So what's facing our economy right now is three risk problems. The first is the interest rate risk. As the Federal Reserve hikes interest rates, this will cause a deterrence in consumer spending, consumer lending, business spending, and business lending. And since we measure economic growth in terms of spending on final goods and consumption, there is a risk now that the more hawkish stance that the Federal Reserve is taking could throw the economy into a tailspin and push it into a technical recession, as while spending slows, the inflation rate doesn't slow as fast as that spending rate slowdown is going to be. And indeed, Jerome Powell has now started prepping markets for the possibility of a 50 basis point hike in the month of May. So whereas before, in the beginning, the Fed signaled that it would raise interest rates by about a quarter point every quarter, it changed that up until recently to possibly a half a point every quarter. Now it's saying that it might do a half a point every 6 weeks. So the Fed is continuously doubling its hawkish stance on its interest rate hikes. And just for a frame of reference, if Jerome Powell and the Federal Reserve Board followed through with these measures for some time, this would be the sharpest, most hawkish stance the Federal Reserve has taken regarding interest rates and inflation since Paul Volcker's administration in 1981. Already what we're seeing on the interest rate front is a rise in interest rates, both on the junk bond yields measured in red here, as well as the corporate bond yields in green and the long-term mortgage rates in blue. However, the Federal Reserve has a long way to climb to reach back more to normal territory in terms of the federal funds rate. This is the federal funds rate subtracting out the annual consumer price inflation rate. You can see here that in the 90s and the 2000s, for most of the time, the interest rates were positive. That is, the federal funds rate was at a higher interest rate than the annual inflation rate. But right now, it's at a whopping negative. And as of the end or the average of March 2022, it was at over a negative 8%. And that's the most dovish that we've ever seen Federal Reserve interest rate policies here in the U.S., even more dovish than what we saw during the 1970s that led up to record price inflation then. So what is going to be the impact on the markets now that Jerome Powell's statements and possible change in monetary policy might have? Well, looking at the stock markets, it's pointing to a severe correction in the stock market. This chart here that I've created a little while ago shows my stock market valuation in orange against actual stock market capitalization in blue. And you can see the strong correlation here. Well, now that we're seeing the 30-year Treasury rate start ticking up and increasing at exponential rates, this is making stocks more expensive relative to bond interest rates, and it will drag down this valuation. Now, do I expect the stock market to just plummet tomorrow? No. Instead, what I expect is that the stock market will start to gradually drop over time until it meets this lower valuation. But if this valuation calculation is true, then we could be seeing play out over the course of the next couple of years or so, as long as the Fed continues to follow through with continuously hawkish monetary policy, we could see a stock market correction of up to 40%. And how that would play out is that it could play out in the form of the Dow Jones dropping to just over 21,000 points from where it is now at around 34,000, the S&P 500 dropping down to over 2,500, the Russell 2000 dropping down to over 1,100, the NASDAQ dropping down to 8,000 as I've charted it out here. So we can see this sloping down of stocks over time according to this projection relative to interest rates and GDP growth. And if that does play out, we are in for a severe bear market in terms of the stock market as that's concerned. The other major problem is that rising interest rates could spark the next credit bubble to burst. So I've created a model in green that has pretty accurately forecasted the bursting of a credit bubble, evidenced by rising defaults and delinquencies on loans, measured here in red. The model is fairly predictive, about 6 months to a year and a half out, and so far so it's been, pretty accurate in its predictions of a credit bubble burst. Well, fortunately right now what it seems to indicate is that, not counting inflation, because as what inflation does is that as new money enters the system, it basically devalues debt. It makes debt cheaper. So not factoring inflation into the situation, we're not really looking at any kind of systemic problems manifesting in the credit bubble unless that the Fed hikes interest rates over 5%. So this is the bank prime loan rate, which is set as the federal funds rate plus 3%. According to my model, we're not going to enter the red territory, meaning that interest rates and debt is too high relative to nominal GDP, until we see the federal funds rate raise over 5%. Now, in my previous model, if you've watched some of my older videos, I stated recently that if the Federal Reserve raised the Fed funds rate up to 1.5% to 2%, that might spark the next recession. And the reason why is because my old model priced in actual real GDP. In other words, it discounted the nominal GDP according to the price inflation rate. But what I was really concerned with here is not trying to forecast when the next economic recession is going to be. I could care less whether the economy technically enters a recession per se on a GDP front caused by rising inflation. What I'm really concerned with here is if it sparks the bursting of a credit bubble, because if a credit bubble bursts, it will create an even more severe economic situation, a more severe recession, and could possibly lead to policies initiated by the government that can make the situation far worse, as well as lead to systemic higher unemployment, a loss of pensions and retirements, a complete collapse of wealth, and possibly the destruction of the U.S. economy as we know it. So fortunately, right now, we're not in any kind of red territory yet. Right now, we're still in the green, but that's only because of these really, really negative interest rates here. If the Federal Reserve were to hike the federal funds rate back up to 8.5%, where that inflation rate is, to try to calm it down, then by all means, this would grossly cause my model to enter the red, and we will start shortly seeing a rise in defaults and delinquencies on loans. So I don't think the Fed will go that hawkish on it. Instead, what I think is that Jerome Powell is hoping that by taking a temporary hawkish stance, he might be able to nudge inflation downwards somewhat and then drag it down slowly over time. However, in my opinion, he should have really done this last year. I don't think he's got much hope to succeed this year. It's too late for that already. The real problem, though, is the bank reserve situation. So right now, bank reserves are sitting on about $3.9 trillion as of the end of January 2022. The record amounts of debt that's going to be levied out onto the banks and the government, sucking out that liquidity, combined with the Fed selling assets, will cause problems in the banking system somewhere around the beginning of 2024, by my estimate. Does the Fed's hawkish stance impact this? Not really, and here's why. When the Federal Reserve raises the federal funds rate, they tend to sell short-term treasury bills to raise that federal funds rate. Well, that's not going to impact reserves at the U.S. banks in the long run. It's what's the Fed selling in terms of long-term assets, such as mortgage-backed securities, 30-year and even 10-year treasuries, that will have a permanent impact, negative impact on the reserve system in the banks. So I don't expect the Fed's more hawkish stance to really impact the banks unless if they complement their higher interest rate policies on the federal funds rate with a higher amounts of selling of federal assets on the long end of the curve. If we do see that, then these expectations can change, and we may start seeing liquidity problems manifest inside the banking system as early as late 2023. The other big problem that we're having right now is a deterioration in real producer output. So this chart here is a measure of what I call gross output divided into real consumer output and real producer output. Real consumer output is nothing more than nominal GDP, since that's the spending on consumer goods, taking into account the CPI. The producer output is the gross output, which measures both the producer side and the consumer side of the economy, subtracting out that GDP number to get that producer effect, and then dividing that by the producer price index. So once we adjust for that producer price index, we can see quite clearly that our economy, in terms of manufacturing, construction, mining, producing intermediate and goods and raw materials, is actually in a full-blown recession. The risk here is that unless if we start seeing a continuous pickup in nominal GDP matching the inflation rate sometime in late 2022 and or early 2023, this could plunge our economy into a technical recession on the GDP front. Again, that's not going to be too much of a concern because the real problems are manifested here in terms of the reserve situation, the liquidity, and the credit risk that we're seeing. And fortunately, those are going to be intact for the next couple of years, but we might go through a technical recession before then, much like what we saw in the early 1980s. In addition to that, that will cause a drop in the stock market, and what this should do over time is push up gold and silver. Now, gold and silver have been dropping for the past month or so, and you might be asking why. Haven't I been predicting that gold and silver would rise from all this? Well, yes, in the long term they will, as the depressing of the stock and bonds assets will cause outflows out of those stocks and bonds and into gold and silver. However, when we take a look at what the stock market is doing, it's really been staying pretty stable. So rising interest rates are slowly forcing down stocks, but they're not forcing them down extremely sharply enough to where it's causing those outflows into gold and silver just yet. In the meantime, gold and silver is being hit by the high interest rates, but there's an expectation now among market economists that the inflation rate will start to moderate in the coming months. Indeed, they're starting to peddle a narrative that maybe what we're seeing is a peak in the price inflation rate. But as I have been projecting out through my endless series of charts, that's just not the case, and it's certainly not going to be the case next month. Next month, I'm looking for price inflation to hit around this 1.2% month-over-month change, which would push up the annual rate over 9.1%. I think that's going to be a real shocker to the investors, as they're not expecting this. The narrative is that core inflation was low last month, inflation has peaked, and it'll calm down in the second half of 2022. If we start seeing this psychological notion that, oh my God, inflation is now over 9%, I think that could spark a mini rally inside of gold and silver. So look for precious metals to start pushing up in the coming weeks, especially when those inflation numbers come out, and that proves to be true according to my projection. Now, if inflation comes out on the soft side, we're still looking at the annual CPI inflation rate staying the same at 8.6. And that's if it comes out on the really soft side, and the confidence interval that I can put on this is 95%. So I'm 95% sure that next month the annual CPI rate will be at least staying the same at 8.6%. It's not going to drop, but probably it will climb, and more than likely it will climb over 9%. And when it does, this is going to be really shocking to investors. And I think what we're going to see is more of an adjustment of the stock price downward, and probably some outflows into gold and silver as panic starts to ensue. Not to say that this will start the gold and silver bull market per se, but that all of this culminating together may start a push-up in gold and silver, and we may see gold push over $2,000 an ounce in the coming second quarter, and silver push and stay over $25 an ounce, maybe even $26 an ounce in the next 2 to 3 months. Guys, thank you for watching this video. I hope that you enjoy the content, and I hope that you're learning something out of all of this. I would love to learn from you. If you have any thoughts about this or insights that you would like to provide to the community as well as to me, make sure you just drop a comment. If you like my content, make sure you like that button, share it on social media. You have my full permission to do so. I encourage it to do this to get the word out and warn people of the dire economic situation that we're in. As always, you can subscribe to my channel. Please do so if you haven't already, so that way you can stay up to date with the fresh content that I provide to you each and every week. And click that notification bell. Whenever you do, you'll be notified as soon as I do upload a video so that you can be one of the first people to see and comment this. Once again, guys, I thank you for watching this video, and I'll talk to you next time.